Gold isn't rallying. It's repricing the entire system, and the cleanest signal isn't the headline price you see on a chart. It's the pressure building underneath it, where most people never look. Because right now, there's a conflict playing out in plain sight. The mainstream story wants this to be a simple inflation hedge trade, something neat and explainable, something that fits into a two-sentence headline, while the market structure is whispering that the move is being driven by math, flow, and timing. And if you catch the hidden detail early, you'll stop getting whipsawed by the noise, and you'll start tracking the only things that actually matter over the next 1 to 2 weeks. What level decides whether $5,000 is a headline tease or an actual magnet, what kind of pullback is healthy, what kind is a warning, and what would outright break this whole setup. Here's the part that should make you sit up. Gold didn't drift up politely, it accelerated. In January, it pushed from roughly the low $4,300 at the start of the month to the high 4,900s by January 22nd, with the kind of pace that doesn't happen because people feel nervous. That kind of pace happens when positioning gets forced to move and the market starts front-running its own future. And that's where the real pressure starts. Because when a move like that collides with a round number like $5,000, the market stops acting like an economics textbook and starts acting like a crowded theater with one narrow exit. Now, before we go any further, let's ground this without turning it into an essay. The tape tells you what's happening, but the plumbing tells you why it can keep happening. The price action into late January has been a sequence of higher steps, not a single lucky spike. You get an impulse higher, a tiny hesitation, then another impulse. That pattern matters, because it's the kind of structure that forms when buyers aren't just interested, they're on a timetable. But that's not the part that matters most. The part that matters is the hidden detail. Gold can look perfectly liquid on your screen while the delivery and hedging machinery underneath it starts to strain. And when that happens, the market's behavior changes. It gets jumpier. It gaps more. It punishes late entries and panicked exits. And it will absolutely try to emotionally manipulate you, right? At the moment, you're most certain you're right. So let's build this properly, with mechanics, with proof, and with the two-scenario lens you need to stay sane. Everyone loves saying, inflation is rising, so gold goes up. It's a nice story, simple, viral. But the real reason inflation matters right now isn't the word inflation. It's what inflation does to policy flexibility, to real rates, to currency confidence, and to institutional mandates. A key U.S. inflation measure recently ticked up in November, with year-over-year inflation around 8%, and core inflation also up slightly, enough to reinforce the idea that the Fed can't just glide into easy cuts whenever markets get bored. And you might be thinking, okay, 2.8 isn't a crisis. Exactly, it doesn't have to be a crisis. It just has to be sticky enough that policy stays uncertain. And uncertainty is rocket fuel for a market like gold. Because gold doesn't need a forecast to win. Gold wins when confidence in forecasts breaks down. And there's your first big mechanism, the trust premium. Gold is not just a commodity and not just a currency. It's the asset people reach for when they want exposure to a world where promises get messy, where fiscal math becomes political, where geopolitics keeps interrupting trade flows, where risk-free is a marketing term, not a guarantee. When inflation refuses to behave, it forces bond markets to keep repricing. When bond markets keep repricing, financial conditions can tighten or loosen fast. That volatility spills into everything. And in that environment, gold is less about earning a yield and more about refusing to be someone else's liability. But here's the next detail, because this is where people get it wrong. Gold can rip higher, even when yields are elevated, as long as the market believes the path of policy is unstable and the credibility cost of future stimulus is rising. Gold trades the regime, not the print. And that's where the setup turns from a story into a structure. Now let's talk about the hidden detail in a way you can actually use. Gold has two realities at the same time. One is the paper reality, futures, forwards, options, ETFs. That world is fast, liquid, and crowded with leverage. The other is the physical reality, bars, delivery, vaulting, logistics, and the real world preference for I want it now versus I'm fine with a claim. When those two realities are in harmony, the market behaves. When they drift apart, the market gets twitchy. And the drift doesn't always show up in the spot price first. Sometimes it shows up in spreads, in lease dynamics, in the term structure, in the way near-dated contracts behave relative to later ones, and in the way participants act when delivery windows and roll periods show up on the calendar. So if you want a higher quality signal than a headline, you look at the curve. And you don't need to be a quant to understand this. In a normal cost of carry world, later dated prices tend to be a bit higher than spot because you're paying for time, financing, and storage. That's contango. When a market flips toward flatness, or in extreme cases, backwardation, what it old is telling you is that the market is willing to pay up for immediacy. It's saying, I don't just want exposure, I want availability. Now, gold is special because it often carries differently than something like crude oil. But the principle holds, if the market starts valuing now more than later, that's a stress signal. That's not about feelings. That yes, about the cost of getting metal or the urgency of not being short the wrong thing at the wrong time. And that is the kind of stress that can make a $5,000 level stop being a ceiling and start being a door. But that's still not the part that flips the whole setup. The part that flips the whole setup is options reflexivity, dealer hedging, round number gravity. You can think of the options market like a landscape of magnets and tripwires. Near big round numbers, you often get a concentration of strikes because humans and institutions love clean levels. 5,000 is clean, 5,000 is memorable, 5,000 is a headline. And when a lot of calls get bought near a level like that, the dealers who sold those calls typically hedge their risk by buying some underlying exposure. That hedge isn't static. It changes as price moves. That's delta. And the speed at which the hedge requirement changes is gamma. Here's Steros, the simple version. When the market moves up into a zone where a lot of calls exist, hedging can force dealers to buy more as price rises, which itself can push price higher, which forces more hedging, which pushes higher again. That loop is why markets sometimes sprint through levels that should be resistance. It's not sentiment, it's math. But here's the catch, and this is where the volatility games begin. The same mechanism that can accelerate price upward can also snap it back violently if price stalls or reverses. Because if dealers are long futures as a hedge and the market turns, their hedge requirements drop, and they can sell into weakness. That's why you can be right about the trend and still get emotionally wrecked by the path. And that's why you need the psychology shield, because gold loves to make smart people do dumb things when the screen turns red for a day. Now, layer in the calendar trigger, because why now is not optional. Late January is a perfect storm zone for liquidity and positioning. Month-end rebalancing starts creeping into the system. Big funds adjust exposures. Dealers manage books into expiries and roll periods. Liquidity can thin at exactly the moments you'd like it to be thick. And we just got inflation data that nudges the policy narrative again, reinforcing that rate cuts aren't an automatic glide path. That combination, compressed liquidity, positioning pressure, and a narrative catalyst, can turn an uptrend into either a controlled retest or a continuation squeeze. And you don't get to choose which one happens. You only get to choose whether you have a plan when it does. So let's proof stack this, because one argument is never enough in markets. Proof point one is the price behavior itself. A move from roughly $4,225 at the start of January to around $4,936 by January 22 is not a gentle drift. That's a market climbing a staircase, while people keep insisting it's an elevator. And when a market climbs like that into a round number, the odds of a volatility event go up. Not because it must reverse, but because positioning becomes asymmetrical. Late buyers cluster near the top, stops cluster below, options exposure clusters at the round number. That's a setup for a fast move in either direction. And that's where the real pressure starts. Proof point two is official sector demand. Central banks have been persistent buyers for years, and the World Gold Council reported that central banks bought about 1,045 tons of gold in 2024, over 1,000 tons for the third consecutive year. That's not day trading, that's reserves behavior. And reserves behavior is structurally different from retail behavior. It doesn't chase headlines, it doesn't freak out over a 2-day pullback. It's slow, steady, and it often shows up as a baseline bid that makes dips shallower than people expect. When that's in the background, breakouts are more likely to hold, and pullbacks are more likely to get bought until something macro breaks that backdrop. Keep that until in your pocket. We'll come back to it. Proof point three is institutional flow reawakening. A lot of the last leg of gold moves in prior cycles has come when Western ETFs stop being passive and start accumulating again. And you can see that theme showing up in institutional commentary right now. Goldman Sachs, for example, has talked about a new gold rush in ETF demand, raising their end 2026 forecast to around $5,400. That's not a promise. It's a signal of what the institution believes is happening in flow. And flow is what moves markets in the near term. When large pools of capital get permission to buy, when their committees stop arguing and start allocating, the tape changes. It's less fragile. It responds differently to bad news. And that's when a level like $5,000 stops being a meme and starts being a level participants have to adapt to. Proof point four is the macro regime argument. Inflation sticky enough to keep policy uncertain, combined with a world where geopolitical and fiscal concerns don't vanish on schedule. Gold thrives in the gap between what policymakers want and what the data allows. If inflation refuses to glide cleanly to target, the Fed has less freedom. Less freedom means higher tail risk. Higher tail risk means more hedging. More hedging means more structural demand for an asset that doesn't require counterparty trust. And that's where the real pressure starts, because markets can ignore tail risk right up until they can't. Proof point 5 is the market structure around $5,000 itself. Even if you don't have a perfect map of options open interest, you can infer the behavior. Round numbers attract positioning. Positioning attracts hedging. Hedging changes the speed of moves, and speed changes psychology. When price gets close to $5,000, the market doesn't just decide up or down. Now it decides whether that number becomes a pivot point, acceptance above, rejection below, or a whip zone that punishes everyone who trades without a plan. That's why the next detail matters. The difference between a rejection and an acceptance often shows up not in the first touch, but in what happens after. Does it break above and hold? Does it break above and instantly fall back? Does it retest from above and find bids? Those are the tells that decide whether $5,000 is a ceiling or a new floor in progress. And now let's add the on-the-ground symptom layer, carefully, without fake precision. In commodity markets, you often see early signs of tightness, not in the headline price, but in the behavior of premiums, delivery preferences, and the willingness of buyers to pay for immediacy. When people want exposure, they're price sensitive. When they want the thing, they get time sensitive. They stop negotiating. They start paying up. If physical demand strengthens relative to paper, you can see it in the way arbitrage flows push metal around. Regions with stronger demand pull supply. Refining and logistics timelines matter. And that physical pull can eventually force the paper market to adjust if the divergence gets wide enough. You don't need to assume drama. You only need to recognize incentives. If someone is short or underhedged in a time-sensitive window, their priority becomes certainty, not price. And certainty costs money. That's how squeezes begin, not with villains, but with constraints. Now, we need the honest counterpoints, because credibility is earned by naming what can break you. There are 3 clean ways this rally can fail without any grand narrative changing. First, the dollar can surge, and financial conditions can tighten fast. If the market suddenly prices fewer rate cuts or pushes yields higher on strong growth, gold can face a headwind, simply because the opportunity cost of holding it rises. Second, risk-on can roar back and pull capital into equities and high beta, leaving gold temporarily unloved. Gold can still be in a long-term uptrend and have a nasty medium-term air pocket when that happens. Third, positioning can get too crowded. If too many participants are leaning the same way, the market can engineer a flush to reset leverage, trigger stops, and shake out weak hands. That flush can be violent, and it can happen even while the underlying structural case remains intact. This is the part people hate hearing, but it's the part that keeps you from getting emotionally liquidated. Being right on direction doesn't guarantee being right on timing or path, so here's your psychology shield, because gold is about to try to trick you. Gold's favorite move is to make you feel like you're missing a once-in-a-lifetime breakout, lure you in near a crowded level, then whip down hard enough to make you question your own intelligence, only to recover once you've sold or hesitated. It does this because the market is not a morality play, it's a positioning machine. And volatility is how it transfers risk from patient holders to emotional traders. Your protection is not a prediction, it's a framework. The framework is simple: separate trend signal from noise and build decisions around invalidation, not fear. Trend signal is the market holding higher structure over time, higher highs, higher lows, strong recoveries after dips, and crucially, acceptance above levels after testing them. Noise is the intraday or 2-day thrash around round numbers, option strikes, and news catalysts. If you treat noise like signal, you will overtrade. If you treat signal like noise, you will miss the move. The trick is knowing what would actually invalidate the thesis versus what is just the market doing its normal violence. So let's define the 2 scenarios that matter from here, because this is the only lens that keeps you calm when the screen turns into a slot machine. Scenario 1 is the controlled pullback and retest. This is the healthy path. In this scenario, gold pushes up toward $5,000, maybe tags it or gets close, then pulls back into a support zone as profits get taken and hedges get adjusted. The key is that the pullback is orderly. It holds a higher low. It doesn't collapse through obvious levels like a trapdoor. If we're using the January tape as a guide, areas like the mid-4700s and the mid-4600s become important reference zones, because we've seen gold trade around those levels recently during this month's climb. In a controlled retest, you might see price dip, stabilize, and then reattack $5,000 with less frenzy and more persistence. That's the kind of action that often precedes a clean acceptance above a round number. And that's where the real pressure starts, because once acceptance happens, the market's mental model changes. Participants stop saying it can't, they start saying it did. Scenario 2 is the continuation squeeze. This is the dangerous path, not because it's bearish, but because it's fast and it can gap. In this scenario, gold doesn't give the market a comfortable pullback. It pushes into $5,000, and instead of rejecting, It churns near the level, building tension, then launches higher as hedging and momentum flows cascade. This is where you can see quick bursts that feel irrational and then sudden snapbacks that feel like betrayal. If a squeeze path kicks in, you'll often see the market respond differently to bad news. It will shrug off things that should have hurt it. That's a tell. It means the marginal buyer isn't buying because the news is good. They're buying because they have to. Forced buying is a different species. It doesn't negotiate. It just prints. Now, because we're dealing with a $5,000 conversation, we have to talk targets, like grown-ups. Targets are not promises. Targets are what the market starts to flirt with when it enters a new regime. A clean break and acceptance above $5,000 opens a psychological runway. The next obvious magnet becomes the mid-5,000s simply because institutions and analysts are already talking in that neighborhood. Goldman's end 2026 number around $5,400 is a good example of how that mental map can form. And if you get a real squeeze, you can overshoot magnets before settling. But don't let targets hypnotize you. The market doesn't care about your number, it cares about flows and constraints. What matters is the invalidation zone. This is the line that tells you, okay, something changed. Well, not, I feel bad, not Twitter got loud, something actually changed in structure. If gold were to lose the mid-4600s and fail to reclaim it, especially if it broke down through prior stair-step levels like the mid-4500s and stayed heavy, that would be a warning that the momentum leg is breaking, and the market might be transitioning from breakout behavior into consolidation or deeper mean reversion. That wouldn't automatically kill the long-term thesis, but it would change the near-term playbook. It would tell you the market needs to reset leverage, rebuild a base, and reprice risk. And the worst thing you can do is treat a changed playbook like it didn't change. So what do you watch next week specifically without getting hypnotized by every tick? First, watch whether $5,000 is rejected or accepted. That sounds obvious, but here's the nuance. Acceptance is not a 1-minute poke above. Acceptance is the market spending time above, holding above on pullbacks, and recovering quickly after dips. Rejection is the market failing above and sliding back with urgency. If you see repeated attempts and shallow pullbacks, that's bullish structure. If you see one dramatic spike and an instant fade, that's a warning of a liquidity-driven move that might need to retrace. Second, watch volatility behavior around the level. If volatility explodes and price can't make progress, that can signal distribution. If volatility compresses while price grinds higher, that can signal controlled accumulation until it breaks into expansion. And that's where the real pressure starts, because volatility compression near a big level can be the calm before the next impulse. Third, watch the feel of dips. Are dips being bought quickly with sharp snapbacks, or do dips bleed slowly with weak bounces? Fast dip buying suggests strong underlying bid. Slow bleeding suggests the market is losing urgency. Fourth, watch the curve and spreads when you can. You're not trying to become a curve trader, you're trying to detect stress signals. Flattening carry, odd behavior and near-dated pricing or signs of urgency can all reinforce the idea that the move is not just speculative excitement, but includes time-sensitive demand or hedging pressure. Fifth, watch the narrative catalyst calendar. Month-end effects are real, especially when a market has already moved hard. Positioning gets adjusted, books get cleaned up, and liquidity can be thinner than you think. Thin liquidity doesn't cause direction, but it amplifies moves. It turns normal decisions into dramatic candles. Now let's pull the whole story tight, because this is where the mainstream narrative breaks, and the mechanism narrative wins. If you reduce this to inflation rising, you'll miss the real drivers and you'll get chopped. The deeper story is that gold is acting like a barometer of regime uncertainty at the same time that flows are aligning. Central banks maintaining structural demand institutions, warming back up to allocation behavior and market structure, setting up a reflexive zone near $5,000 where options and hedging can accelerate the move. The hidden detail is that the plumbing can tighten even when the screen looks fine, and the calendar can force behavior even when the headlines feel minor. That's the setup. And the next detail is what flips the whole thing. The market is approaching a level where participants will be forced to reveal whether they re-hedging, chasing, or defending. Here's how you keep your head when it gets loud. You do not marry a single outcome. You hold two scenarios, controlled retest versus continuation squeeze. You define what confirms each, and you define what invalidates the near-term structure. Then you let the market show you which one it chose. If we get scenario one, the controlled pullback, the goal is not to panic sell a dip that's actually healthy. Healthy pullbacks are the market exhaling. They let structure form. They let stronger hands absorb weaker hands. And they often set the stage for a cleaner, more sustainable break above a round number because the move becomes less leveraged and more owned. If we get scenario two, the squeeze, the goal is not to FOMO at the exact moment the market is most designed to punish FOMO. Squeeze phases are where you need position sizing discipline and time horizon clarity. because squeeze phases can give you upside fast and then steal it back faster. The market can whip around violently even if the thesis is correct. That's not a warning to be scared. It's a reminder to respect the instrument. And now the part nobody wants to hear, but everybody needs. If you are emotionally tied to being right, gold will make you miserable. If you're process tied, gold becomes readable. This market is a liar in the short term and a truth teller in the long term. Your job is to avoid making permanent decisions based on temporary emotion. So here's the concrete payoff I promised at the start. The $5,000 level is not a mystical number. It's a behavioral trigger. Above it, you can get a reflexive acceleration because options and headline chasing flows stack on top of structural demand. Below it, you can get violent chop because the market will attempt to flush leverage and harvest stops. Your job is to watch for acceptance versus rejection, to track the quality of dip buying, to respect the calendar, and to keep one eye on the plumbing, curve behavior, hedging pressure, and any signs that immediacy is being priced differently than time. And if you want a final simple rule for the next 1 to 2 weeks, make it this. Don't confuse speed with safety. A fast move can be real and still be unstable. A slow pullback can be scary and still be bullish. The market will try to make you react to speed. You respond to structure. If you're the kind of investor who wants mechanisms over memes, who would rather be early and patient than late and emotional, you're already playing the right game. Stay around the people who care about plumbing, not just price. Keep your thesis flexible, keep your sizing sane, keep your invalidation honest, and let the market do what it always does, show you the truth after it tries to trick you first.